This is Fresh Thinking with Optiro, the podcast where we share ideas from the world of mining and how they apply in industry today. Welcome to Fresh Thinking. My name's Adam Mullett. Today I'm joined by Mark Warren, Managing Director of Optiro. This is episode 16, but it's also part 3 of a 4-part series on due diligence. The first 2 parts were on what is due diligence and what is in the scope of a due diligence. And this episode is about the due diligence process. So Mark, let's continue. What are the steps in the process of doing a DD?
Hi Adam. Well, before I even get into the steps of the process of the DD proper, I need to talk a little bit about the steps you need to do before starting the DD, which sets you up for doing the DD in a efficient manner. So the DD, after all, is just a step in a bigger process. It's a tool you're using to assist in understanding the value of what is the main game, and that's buying and selling an asset and ensuring that you understand what you're transacting and that you're getting good value. The DD is not the end, it's just a means to achieving the end. So we've got to look at the DD in the context of this bigger process. For a buyer, by the time you get to doing a DD, let's assume you've probably been in negotiation with a seller for a while. You've had an idea of the deal to be done. Maybe you've got a letter of intent in place or a signed term sheet as either in drafting or has been drafted. The deal may be something you found yourself, or commonly your corporate advisors found the deal for you and is guiding you in the process. Early in that process, you probably signed what is known as a CA.
Hold on, Mark, what is a CA?
Yeah, a good question. A CA being a confidentiality agreement. It's a document that you sign that allows you to look at the seller's detailed information that they do not disclose to the market. Sometimes you'll come across people that have a fairly cavalier attitude towards CAs or confidential agreements. Maybe you have, as the buyer, you're thinking, well, it's I'm getting the information for free. Why do I care? Well, I'd be very surprised if a seller would give you a CA or a look at the assets, without a CA. But even so, it's probably prudent for you to make sure you sign one before you proceed, because there are some obligations for both sides when you start basically becoming an insider to that company by seeing information that the public are not privy to. As I said, it's always important to the seller, but even more important if they're publicly listed, because it allows them to disclose information to you that they are not subject to their continuous disclosure obligations to the market. It also has ramifications for you as to how you can use the data, who can see it, and how it's to be kept secret, not just for the general principle of the seller's rights to keep their secret, but also for the seller to comply with the listing rules that I've just mentioned, such that they are not creating a market where some people are better informed than others. Keep in mind, as I said, once you have signed that DD, you are basically now an insider to that company, and all of your team are now insiders to that company. In other words, that means you can't be trading the stock of that company whilst you're in that privileged position. Otherwise, you are breaching insider trading regulations. So you can see that undertaking the DD process and signing the CA has some ramifications, not just for you, but the whole DD team. And when you consider the DD team, consider that you'll also have external advisors, and that's why you need to make sure all of those advisors are also signed on to that DD. Otherwise, they can put you at risk of breaching the law. So getting the scope of the CA right in the first instance is important. It's important that you make sure that people abide by them, and it's important that you spend the time to get it right. So it might take minutes to get the DD signed, but it could take a day or longer to get that done, particularly if there's any potential conflicts with any of the team on previous work they've done that would see them in a position where they can't sign the DD, and then you have to therefore go around and basically substitute somebody else into the job. Once you've got that DD out of the way, you then get on to the job of defining the scope of the due diligence exercise. If it's an external party or a consultant team, you're probably going to want to get a quote from them just to control the costs of the whole exercise of doing the DD, unless you've got a retainer or some sort of agreement in place. You can probably expect that will take a week or so all up to get that done. Okay, so now we've done a bit of negotiating, we've got a CA in place, we've defined the scope. It's now about trying to get into the DD, the first question of which is looking at the data that you've been given privilege to look at. Today, information is almost always provided electronically. Sometimes the data is only a small amount. They might give it to you on a memory stick or some portable hard drives, but more commonly it's via an online data room.
That's an interesting word. Mark, is the data room actually a room, or is it some sort of online dashboard, or how what does that look like?
That's interesting. The term data room and the use of the word room really does come back from the history of the fact that pre-electronic world, in a totally paper-based system, in such an exercise, a room would be set aside, confidential, where people were not able to gain easy access to, and all of the documents that the company is disclosing would be laid out in the room. And you'd have some sort of controlled access mechanism whereby you had knowledge of how much information as a seller you'd provided to the buyer, and from the buyer's point of view, how much they got to see. It is important to know what records you have shown people and what not, because that can have an impact on any later comeback, if you like, or any later litigations that could come if you haven't disclosed all of the information. It's, the issue of full disclosure is important in a DD from the seller's point of view, and from the buyer's point of view, it's about trying to get as much information as you possibly can. These electronic data rooms are typically web portals run by third parties. They give the seller greater control of access to the information in a structured way on a user-by-user basis. Two such portals are Firmex, a Canadian company, and Ideals, a US-based company. The benefit of the data room for the seller is, as I said, it allows you to see exactly what the buyer has looked at, and there can't be an excuse given by the buyer down the track if they said, well, I didn't see that or I didn't know that. Well, you can say, well, hang on, I provided you all this information and you can see you accessed it on this and this and this time. So it's clear that you've provided full disclosure to what you're selling. As far as data rooms go, from our experience, access to the data room for the DD is the first typical delay in the DD process. And look, for whatever reason, it often takes a week or two to get access to the platform from the time everybody says, great, let's start this project, we're starting the DD tomorrow, and then we have this immediate hurry up and wait while we get access to the data. I suspect it's typically that the seller is behind the scenes populating data into the room, something we'll talk about later. As a seller, you're typically not ready. Sometimes there are, because the process has been running with other parties before and they're in a more advanced position, but my experience is that quite often that's not the case. Another delay after that in setting up these data rooms, like everything, there's software and they have multiple features, and sometimes the data room manager on the seller side gets a little bit overzealous in using some of the features, and particularly the security restrictions in making documents unusable. For example, in doing these exercises, I think it's important, I want people to understand, is that the company that's doing the DD, the buyer, has to look at a lot of data in a very short time, and it's simply not practical to try to open multiple megabytes, in case gigabytes of data on an online portal through a web page. Perhaps where these portals were designed in the United States and otherwise, they've got internet bandwidth that works for them to that speed, but quite literally when we're spinning through documents rapid fire, that doesn't work. So we would typically download the whole data room onto our system, on our server. People will spin through that data very quickly, and when the job's complete, we delete it off our system to keep compliance with the confidentiality agreement. So it's important to get that sorted out, otherwise the DD team again spins their wheels trying to get on top of looking at the data.
So you've mentioned in a previous episode that these DDs need to be kept quite quick. to keep the deal moving, how much time is involved in actually going through one of these DD assignments?
Yeah, look, there can be a wide variation depending on a number of factors. With those process steps of negotiation, signing CAs and getting access to the data room now out of the way, it's time to undertake the DD, and that's going to depend on what you're looking at. You'll recall in our last episode we talked about the scope and mentioned that the scope varies greatly dependent on the level of review, whether it's an exploration asset or it's an operating mine, is it desktop only, or are the site visits included? And this all varies the time that it takes. But to summarise the DD activity, I'd give a broad brush statement and say if it's a simple exploration asset you're looking at, or perhaps it's just an historical asset that's been offered up for sale, there's not a lot of new data, it may only take a week or two to assess. At the other end of the scale, if you're buying an asset that may be in the hundreds of millions to billions of dollars of value, that's going to involve a multidisciplinary team, and it's going to take over a month or more, maybe up to a few months. In the middle somewhere, we find for looking at most junior miners, it's typically a 3 to 5 week process.
Right, and I imagine that like some being short and some being long, there's also a wide variation of the levels of detail that you can choose to look at.
Yeah, there sure is. As I mentioned at the outset of this series, I've been involved in this not just as an advisor in helping with DDs, but also as the person selling companies and buying companies. I was a CEO of a metals business once, and the buyer chose to do what really was a root and branch look at every single contract we had in place, every piece of the operating plant. Basically, the DD took 6 to 9 months. So these things can go a long way. I mean, clearly we wanted to sell, so we entertained them, but it was pretty frustrating. However, our experience is that people aren't typically like that, and they don't want anything like a full DD where they want to check out every document. It's just not practical or value-adding. A lot of people come to us and say, I just want a high-level DD. That's a typical thing, and or they sometimes refer to it as a fatal flaw review. I mean, I must say I don't like the term fatal flaw due to the negative connotation, because after all, it should be looking at opportunity. You're not just trying to look for why it's broken or reasons not to buy it. Sometimes people have the view that fatal flaw means, well, I am keen to buy it, but I just want to see if there's anything that would cause me to stop buying it, which is a reasonable mindset to have. But again, I think always see DD as an opportunity to see how the asset could be more valuable in your hands than it has been to the person that's selling it, because of you're in a different position to extract value out of that asset. Anyway, a DD, in my mind, can be anything from a quick opinion, and we've done that staged approach, or I've been involved in that staged approach where I'm just providing friends' advice on something, a quick spin around, look at something over a couple of hours, or maybe we even spend a couple of days just looking at the geology via public data before deciding whether to proceed through. And it can be anywhere from that to, as I said, a very detailed review with a multidisciplinary team running over some months. I am a fan of that staged approach, and just doing what you need to do early and understanding what you get in before committing to all the money and the time of a DD, which of course it's not just money, it's also your time and distraction from other parts in your business.
Well, thanks, Mark, for that overview of the process. The first 3 episodes of this 4-part series have been a really good summary of due diligence. In part 4, we're going to be going over tips and traps for buyers and sellers. If you've enjoyed this episode of Fresh Thinking, you can hear more by going to our website, optiro.com, or you can subscribe on all the usual services like Apple Podcasts, Google Podcasts, Spotify, or Stitcher.